All value right now. Our next guest points to October as a seasonally iffy part of the year, expecting investors to buy whatever dip emerges this month because the positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes. I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year end because, as you're pointing out, the VIX is just staying stubbornly high.
Tom, we've seen some changes in the swaps market with regard to expectations for future rate cuts, at least in terms of magnitude. How does that alter the calculus, if at all, for the equity markets? If it is now looking more like a 25 basis point cut in November instead of 50 basis points in those weightings changing, does that impact expectations in the equity market, or that's not really priced in at this point in time?
Well, we know that Fed fund futures and expectations about the magnitude of cuts over the next couple of meetings does affect the bond market. And we're seeing that reaction today. And, of course, I'm even seeing some folks think the Fed made a mistake with 50. But for the stock market, I think what matters more is really the Fed. The Fed is actually in an easing cycle, and we're making our way towards neutral. And so I think that there is going to be times where the stock market, where the S&P is going to rise even if yields are up. I think we're in an instant there because yields can be rising because the economic data is better, and so we're kind of rising for good reasons on yields, and I think that's supportive of stock. So I'm not too bothered if the odds of a 50 have dropped today because of a good jobs report, because I don't think it means the Fed is suddenly backpedaling and back to hiking mode.
On China, Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity or just the rush of hot money to either cover shorts over there or try to play along with this?
I think on balance, it's very good news that China's PBOC and the government have launched a bazooka series of measures because it has been, on a relative basis, a drag not only on the global economy, but a huge underperformer for the past 10 years. I don't think U.S. investors are selling their U.S. equities or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion. And we know there's $6 trillion cash on the sidelines. So I think this is motivating money into action, but it's overall, I think, a positive.
Yeah, your point on margin debt, I think you made last week. Do you want to explain to viewers why you think that number is important to watch?
Yes, I think something that investors should pay attention to is the New York Stock Exchange levels of margin debt. It's really how much borrowing or risk appetite there's been. And we've now had 4 consecutive months where margin debt actually has fallen on balance. August was the biggest decline of margin debt since October 2023 of last year. It means investors have been really cautious in the face of a stock rally. I mean, the market's been up four of those months. So 4 months of rises and margin debt down. That tells me that stocks have fundamentally risen because risk has actually dropped. It isn't because people are buying stocks and pushing them higher. And I think that's the dynamic we could see after Election Day. So this is really telling us there's a lot of firepower on the sidelines.
As for year end, Tom, are you comfortable with a 6K target?
I think that's what should be people's sort of base case. And it's the simple logic of since 1950, when the S&P's up more than 10% in the first half, the second half gain is 10%, and that's been true 83% of the time. All of the instances where the second half of the year was down were when Paul Volcker was Fed chair, and we don't have a hawkish Fed chair today.
Right. Those were different times, at least we hope they were. Tom, obviously we'll have a lot of chances to talk about markets between now and year end. Thanks for today, though. Tom Lee.
Yeah, great seeing you.
Great to see you.